So I'd just like to take a quick look at the COVID situation. And I mean, this is unprecedented. Compared with the 1930s recession and the Great Depression, 93% of, of the world was impacted by this COVID-19. The Great Depression and the 1930s recession was probably somewhere around 70-80%. So we know this was a devastating blow to our economy, for example, and obviously to many economies. So in the case of Barbados, the GDP fell almost 20% last year. And we've already seen the further declines already. We heard it from the IMF how that is going. And this is across the Caribbean. This is not only Barbados. And tourism has declined as much as 96%. Revenue, we know government revenue has been hit, declined 12%, saved only by the corporate tax that was paid by the international business sector, which is about 249 million. Had not for that, we would be in even worse position. So basically every sector in Barbados was affected, employees, the households, and as I said, this continues. This has not stopped. So there've been some significant shocks to employment and to household income. So there are some moratorium for various loans, but a lot of those have come to an end. And there are several persons that, well, I shouldn't say several, but there's some individuals who have been significantly impacted and have lost their homes during this period. So it's a little concerning. So I want to take a quick look at the household debt in the Caribbean, not only in Barbados, but there's studies that have been done throughout the Caribbean. And the Caribbean, it points to lower debt than the rest of the world, right? So the average household debt in the Caribbean is about 4 times lower than certain parts of the world, and particularly the US. The highest debt right now is held by the Bahamas, Antigua, and Barbuda, and Barbados. And to just give you an example for Barbados, we've seen over the last 20 years, we've seen debt growth of from 500 million to 6.1 billion in 20 years. And the majority of that debt has been for mortgages, okay? And so that's just about 60% of the GDP, and compared to Trinidad, for example, which is about 22% of GDP. So we are spending quite a bit of, or we are taking on quite a bit of debt in terms of mortgages and so on. They said the mortgage debt is the highest, followed by consumer debt, but credit card usage is growing significantly. The last report I saw, which was 2017, which actually gave the size of the credit card debt was about 300 million in Barbados. And there were over $700 million in transactions, the vast majority of which were for personal credit card transactions. So it suggests to me that quite a few of us individuals are using our credit card for probably even day-to-day living, week-to-week living, which is very concerning given the high interest rate associated with credit card debt. And as I said before, there's been quite a bit of restructuring for credit card debt that could no longer be serviced through that medium. And unfortunately, the card should be cut up and thrown away, but that's not the case. And typically clients find themselves in the same problem. So that is a little bit of a concern. The size of the credit card that has grown significantly over the years. Oh, there are a couple of signs that you are in financial distress. And I mentioned a couple of them before. One, you don't know your monthly expenses. So, you know, typically I would ask, what are you spending per month? And most people will say, well, I spend about $1,500. So there's some person who's working for $2,000 and I save $500. So I ask them as a follow-up, so how much do you have now? How much money do you have saved? Because they told me they're saving $500 a month. And the answer is usually, well, I have to go back and take it out and do this and so on. So it suggests to me that, yes, you may have left $500 at the end of the month, but then you were going back and taking it out. So you're not really being true to yourself in terms of your monthly expenses. The other thing is to know your when you don't know your loan balances, your interest rates, your credit card balances, that is really cause for concern. And again, your monthly savings amount. And several Barbadians still do not have any savings or investments. I'm going to talk about investments a little bit later, but they don't have a savings that can tide them over. I mean, they're in a much better position, I would say, than Americans. Americans are, it's suggested that they have less than $300 in savings on the bank. So we typically have a slightly higher amount, but they, they're still concerning how many persons actually don't have anything, right? So some of the coping strategies that you need to have, you need to know your financial situation. You need to know how much your bills are. That's why we need to write them down. You need to know your debts. You need to know what you're paying for, because I know several of us are paying for small things that just shoot onto the credit card or onto the account, and we're not paying attention to it. Like the Netflix bill that comes and is like, oh, I forgot that, that kind of thing. So you need to be able, you need to know, and you ought to really consider whether these debts are debts that you really want to have. Know your debts and know which loans have flexible payments, because there are some situations where you can have some flexible payments. And I just want to say here at this stage that as far as credit cards are concerned, you should never only pay the minimum balance. You're setting up yourself to be in financial trouble down the road. I had a niece and she lived in the US and she was studying, and you know how the credit card companies all come to the university and they sell you, just come and you're a student. She was a student, come and get a card, etc. And when she completed university, she was not able to repay her loan. And she had to get her mother to sign for her car because she could not buy a car. She was excited about receiving this $1,000 on this credit card. And she went and bought this and that without understanding. So these things can ruin your credit rating as well, but the thing is that please do not only pay your minimum balance. Try to really only, first of all, charge items that you really need on your credit card, and then have a plan in mind for paying it off. In fact, you should have 6 months of the balance that you are, or your limit, before you even start to take on a credit card. You need to track your expenses for 1 month, one full month. And this was my advice to many of those persons who I counsel. Track your expenses for 1 full month. And what you should include in there are things like, if you pay insurance in January, you should not only try to, if this is a non-payment month for your insurance, but you should divide those insurance payments into 12, so that every month you are paying some portion of that towards insurance or whatever expense it is that you have to incur, that you're going to pay the full amount in one specific month, or even over a 3-month period, but you should account for it every month. So plan your budget, build in an emergency fund. And what I mean by emergency fund, sickness happens, accidents happen. So you have situations where a pipe is left on and the house is flooded and you have to pay the plumber, and you have to have the money. That's as simple as that. Or something happens to your electricity. And this is a really interesting one. I discovered a couple of years ago, which I didn't know after being a homeowner for a number of years, that you should really be doing electrical maintenance every 5 years. I'm like, what? Because one night we were here at home and the lights just went out, and the guy came and he said, you know what, you should have been servicing your electricity system. And I'm like, oh, I did not know that. But the reality is that there are things that happen that you didn't anticipate. And so you should really, in your budgeting, make sure you put aside some funds for an emergency. So you should also make saving and investing a part of your planning. I said this earlier, pay more than your minimum on your credit card, and make getting out of debt a priority. And where you are finding yourself in a struggle to service your debt, you should really try to go and speak to your banker, your relationship manager, whoever that person is, and consolidate your debt to a payment that you can afford to pay comfortably, but destroy all the cards, dump them, so that you do not find yourself back into debt.
Okay, before you move on, Marcia, sorry,
Sure.
I have just a question because you said that you should have about 6 times your balance before you start using the credit card. Now,
6 months, yeah, 6 times your limit. Sorry.
6 times your limit. So a lot of the credit cards come with ridiculous limits, like $5,000 or $10,000. Typically, people who need credit cards don't have $60,000 on their bank account. So what is like the second level that they should have?
Okay, thanks for that question, and I'm glad you asked that. So the key thing, though, I mean, that is a little bit, because I'm thinking of a $1,000 credit card, for example, right, where you should have like a 6 times. Obviously, if you have a higher limit, then it's a little bit more challenging to have that much funds available to service it. The key point, though, is that we don't want you to exceed your limit, one, because there are limit charges associated with that, and also not to purchase items that you don't need. You only use the card for important or I should say, I would even want to go as far as to say for purposes that will give you some type of return, right? Rather than just for consumption. And that is really deterrent. We really don't want you to be spending your money on consumption on your credit card, because a pair of shoes that you buy for $50 now, because you're not paying it off in a timely manner, will really truly be costing you $300 or $200, right? So it becomes very costly if you're not planning very carefully what you spend using your credit card. So I want to move on then to some investing and wealth creation. So we've heard about the power of time, the power of compounding, and the importance of the rate of return. And I want to say here at this point, I really was not very good at math at school. I put up my hand, and that is the truth. I really wasn't very good. But what I realized now, looking back, at least when I got to university level, I realized that a lot of it was just math, and so was so abstract, and things like trigonometry and cosines and these things, just geometry. I was glazed over. It is not, that is the truth. I did not have a clue. But I found that because when I went to university, I found that it made more sense what was going on when I did math. And from then, my whole disposition towards math and so changed. So I think, to be honest with you, I know that the school syllabi is so crowded that we may not be able to add financial planning and financial literacy to the school syllabus, but maybe we can probably incorporate it more in some of the subjects that we already have. So in maths, we should do things, the power of time, the power of compounding, and the importance of the rate of return. These things are absolutely critical in driving you to invest, one, and to create wealth. And there's so many situations where people do not understand what this means. In other words, the earlier you start to save, the better it is for you. You will save more. In other words, if you start at 20 versus 35, for example, a 15-year difference, it could mean that your money could have been doubled, even if you had stopped at some point in that after you started as a 20-year-old. So it is absolutely critical that you understand these principles. And these are some things that we will try to discuss in the future in a little more detail. So time, compounding, and return. There's something called the rule of 72, which is basically shows the dramatic effect of time, compounding, and the rate of return. So your money will approximately double at a point in time determined by dividing 72 by the percentage interest rate you earn. So for instance, if you had 20, But in 20 years, if you were investing at 2%, it will take you about 36 years to double your money. The higher the interest rate, then it really has a impact on how your return, or time in which your return will be doubled. I hope I didn't mess up that there just now, but the reality is that the rule of 7-2 is very, very important to understand when you're investing. And it works, it actually does work. So let's look at two scenarios. Investor who has more at 65, investor A who invests $1,000 a year from age 40 to 50 and stops to let it grow, or investor B who invests $1,000 a year from age 50 to 65. Who do you think will have the bigger retirement pot, so to speak, at age 65, right? I think that should be obvious, but I would like you to put it in the chat and let me know what you think. And this is assuming a 7% annual return.
All right, we have one. So we have an investor A coming in as an answer. Let's see what else we get.
Mm-hmm. Yeah, that's correct. It will be investor A. Even though investor A stopped, the reality is that look at the time, at the age that he started. He started when he was 40, right? And remember that even though he didn't put in any more after 50, that money was still earning for him, right? Or her. I just don't want to be sexist here, but the reality is that investor B probably started very late, and he would probably have to seek to put in a significantly higher amount per year in order to have as much as investor A at the age of 65.